3 leveraged investing plans and the risks before using these advanced investment tools. Introduction. When viewing a traditional leveraged investment plan in which one borrows funds to purchase investments, it is essential to know the potential risks associated. First and foremost, be informed that both investment gains and losses increase. While your investments could decline in value, your responsibility to repay the loan and associated interest costs will remain. For this purpose, this strategy is best suited to expert investors, who already have a solid foundation of wealth and financial stability. Investors using leveraging method should have the ability to service debt payments from consistent cash flow. They can withstand potential increases in interest costs from the current historically low borrowing rates. Strategies that could assist reduce the essential risks of leveraged investing involves investing for the long term as the risks of leverage investing drop with period. Making blended principal and interest payments upon the loan. Having a diversified and disciplined investment strategy, rather than following trends. Margin trading risks. Margin trading is the act of acquiring funds from a broker to invest in financial securities. The purchased stock serves as security for the loan. The primary reason behind lending money is to utilize more capital to support and, by extension, the potential for more profits. Margin trading can increase an investor's gain significantly. However, it can also increase his losses. Investors can finish up losing more than what they initially invested. Some traders believe that being indebted to brokers is more accessible than dealing with banks or financial institutions. But in fact, this type of debt is as covered as the one with banks. A margin call is when a broker requires the trader to add more money to a margin account until it reaches the required maintenance level. In the margin loan agreement, a broker has the freedom to act if the investor declines to live up to his commitment. Options trading. Options trading can appear more complicated than it is. Options trading is the trading of means that give you the right to buy or sell specific security on a particular date at a particular price. An option is a contract linked to an underlying asset, example, a stock or another security. Options contracts are suitable for a set period, which could be as short as a day or a few years. You have the power to trade the underlying asset when you buy an option, but you're not obligated. If you determine to do so, that's called practicing the option. Suppose you're a DIY investor diving into opportunities with a self-directed account. In that case, you're in complete control of your trading judgments and transactions. But that doesn't mean you're alone either. Lots of communities make traders together to discuss things like the current market outlook and options trading strategies. In terms of benefits, options trading can allow flexibility as well as liquidity. Related to other investment options, you may be able to invest with more minor amounts of capital. Options can be applied to create downside risk protection and diversify your portfolio. Leveraged ETFs. For expert investors, leveraged ETFs are helpful in statistical arbitrage, short-term tactical strategies, and for practice as short-term hedges without the necessity to roll futures. For individual investors, leveraged ETFs are alluring because of the potential for higher returns. Conclusion. The decision to take a strategy is more important than the strategy itself. Indeed, these strategies can generate a significant return if the investor decides and commits to it. It is essential to select because the sooner you start, the greater the effects of compounding. Remember, don't focus exclusively on annual returns when choosing a strategy.